The Australian dollar chalked up the biggest gain today among major currencies against the U.S. dollar. Since January, the currency that circulates down under rose almost 8%. My next guest says that is why he favors investments in Australia over the United States. Peter Schiff of Euro-Pacific Capital joins me now. Thank you very much for joining us, Peter. Tell us a little bit about why are you so bullish on Australia and New Zealand? What's the strategy?
Well, it's really a two-part strategy. The first part is I'm very bearish on the U.S. markets, mainly because I'm bearish on the U.S. dollar. I think there is a strong likelihood that the dollar will lose a very significant percentage of its value over the next few years. I mean, maybe 30 to 50% of its value, and maybe a lot more than that. So I think it's very important that Americans understand this risk and take actions to preserve their wealth and protect their purchasing power by investing abroad. And we invest for clients in Europe, in Asia, and we also like the Australia-New Zealand region, particularly because of the commodities exposure that you gain by investing in major commodity exporters.
Well, let's take a look. This is the New Zealand dollar chart here. Is this going to continue? Is this strength in the New Zealand dollar going to continue?
The New Zealand dollar just hit a new 52-week high today. I think the chart looks good. They have much higher interest rates in New Zealand than we do here, and I think their economy is in far better shape. And I think they're going to be the recipient of quite a bit of capital flows out of the U.S. And they're also going to benefit from the growth in Australia. The two economies are very tied together, and Australia is a major exporter of commodities, mainly minerals.
Okay, here's the Australian dollar. The same kind of price movement. Do you think that this is going to happen against the U.S. dollar?
Absolutely. And I also think one of the interesting things about New Zealand is I'm very bullish on agricultural commodities. I think they haven't had as big a move yet as metals like nickel and lead and zinc and copper. But I think you're going to see a big move up in those type of products, which would be very favorable to the balance of payments of New Zealand.
Well, let's take a look at some of the, before we get to some of the food commodities, let's take a look at some of the more basic commodities, basic materials. For example, one of the companies in Australia that you do like is Gloucester Coal. Tell us a little bit about that. I mean, the company is going to be trying to double its production or add to its production.
I mean, the world is looking for alternative energy to oil because the price of oil is now up around $60 a barrel and headed quite a bit higher, as a matter of fact. I mean, I'm looking for prices way north of $100. And, of course, as oil prices rise, there's more demand for alternatives, such as coal. And Gloucester Coal, I think, is the premier coal company in Australia. And they're in a position to export into the Asian economies. And I think those are going to be the big users of coal. That's where all the production is going on. That's where all the manufacturing is. And they need a lot of energy.
Now, Gloucester, as I understand, has coking and thermal coal as well.
Correct.
So for steel making as well as for power utilities.
Right. And for as far as my clients, the good part about it is it's got a great dividend yield. And that's one of the most important things when you're looking to make an investment. A lot of investors forget about the importance of being paid, getting a return, not simply banking on capital appreciation, but getting real income as an owner of a company. And we're getting great dividends denominated in Australian dollars by owning a stock like Gloucester Coal. And if you pull up a chart, you can see the kind of appreciation that the stock has had over the last couple of years.
Okay, let's take a look at a chart of Gloucester Coal there. So here's the stock appreciation that you're talking about.
And if you look at, look at that chart pattern. I mean, that looks like it's going to break to the upside once again.
And we see the strong volume here going to the upside as well. Is that a bullish signal for you?
They had good news that came out. I remember that day. It's also important, too, that people remember all these stocks, like Gloucester Coal, it's mainly trades in Australia. People can buy them in the U.S. on the pink sheets. But it's important not to do that. There's some market makers there. There's big spreads. The most important thing that you can do is to buy a stock like Gloucester Coal through a company like mine, Euro-Pacific Capital, where you can get direct access to overseas markets and not have to trade through domestic market makers.
But let me ask you about Gloucester Coal because, I mean, for example, I think that they've got some competition from coal companies in South Africa.
Sure.
Coal transport rates are coming down, so they might be shut out of some of the markets that they are now that they really have a lot of presence in, particularly shipping coal to Europe. I know that the Netherlands is one of their big markets, and there's some talk that they may be displaced as a coal producer there. Does that concern you at all?
Well, I mean, every time you make an investment and you own a company, you take some degree of risk that something negative might happen to impact the business. That's why you don't put all your eggs in one basket. We own many different companies, but I think the risk-reward on Gloucester Coal looks good. I've been buying it. It's done nothing but go up. and I'm going to stick with the stock. And right now, the yields are still great despite the price rise. Because
let me ask you, why just coal? I mean, wouldn't you want to go into uranium? For
example? We are. We've got a lot of, there's only so many stocks we can talk about on the show. But yes, I've been buying uranium stocks for years. And I've been buying other mining stocks, some of them we're going to talk about. Sure, this is part of an overall strategy of ours to own natural resource-based companies. This is just one of them.
Okay, I just want to let people know that there's some news that's crossing that says that the Prime Minister, Howard, says uranium demand is a timely opportunity for Australia, and that he calls on Australian states to end a ban on uranium mining. So this would
that would be great.
With your scenario?
That would be great for a company like Summit, which we own down there in Australia, which would probably benefit dramatically from that.
Do you think that there's going to be more consolidation in the basic materials? I mean, there's been the Peabody acquisition in Australia. Is there going to be more acquisition there?
No question, especially with all the money now going into private equity funds. That's where the money is going to be made. I mean, natural resources, commodities are scarce. The demand is going to continue to grow. The supply is constrained. I see a lot of acquisitions in these companies.
What do you think about coal prices? They've just signed some agreements with some of the Japanese as well as the Chinese consumers of their coking coal. Is this something you
prices? I think are going to continue to rise, particularly from a U.S. dollar perspective, because when the dollar really starts to decline, that means that these prices, which are all traded in dollars, and even though they manufacture or they mine in Australia, these are dollar-priced commodities. As the dollar falls in value, these prices are going to rise.
All right, let's talk about another dollar-priced commodity, which is zinc, and this is Zinc. This is another company that you like. Tell us about it. This is the second largest zinc producer in the world.
Right, and lead. And a lot of people don't even know this. It's also the fourth largest silver producer in the world. It's got a great dividend yield. I mean, the stock probably still trades on a P of 5 or 6. And look at that chart. I mean, we've been buying this stock for a couple of years, and I mean, look at the gains that we're getting. And the dividend yields are still there. And I'm still very bullish. The market is still underpricing this asset. Everybody thinks that zinc prices and lead prices are going to collapse. I think they're up maybe something like 80% so far this year. I see no sign that these trends are over. I think, the commodity bull market really began probably in the late 1990s, 98, 99. I think it's got another 5 or 10 years left to run. And
so do you think any pullback in the price or any decline? I mean, we saw declines in copper prices.
Sure.
Do you think that any pullback in price, is that a buying opportunity for investors?
Yep, it's a tremendous buying opportunity. This recent pullback in copper we've had this year, there's so many people now calling the top in the copper market. Any declines, I think, are buying opportunities, particularly for American investors.
Okay, now in Zinifex's case, they as you say, they're not only zinc, but they're also in the lead mining, and they're trying to bring on a new mine in Australia right now.
And they've got smelters. They've got
joint venture projects for smelters. Does it concern you that at a certain point so much of this news gets baked into the stock already, and that so many investors are already have absorbed the story?
Right. When the stock's at 5 or 6 times earnings, I don't think that that's the case. If the stock starts trading at a lofty multiple, then I might start thinking differently. But when I can still buy this company as cheaply as I can,
so you'd still be buying here. We're at 18 Australian dollars.
Look at it. I mean, where do you see much downside in that chart? I mean, certainly if there was a major breakdown of that moving average, but no one's been able to buy that moving average. Look at the chart; it's never even hit it.
Okay. Now let's just because we want to move from Australia just to New Zealand, just to be fair for the countries down there. There's a company down there. It owns the only oil refinery in New Zealand. This is New Zealand Refining. Why do you like this?
Another good stock. I mean, number one, I like it because of the dividend yield. I mean, it has a great dividend yield, and of course, again, the dividends are coming in New Zealand currency. It's important that you have income in New Zealand. But look, the stock is very closely held. The 3 biggest shareholders, I think, are British Petroleum, Royal Dutch, and ExxonMobil. They're also their biggest customers. So you've got the oil companies who own the stock. And, there's not a lot of stock out there. It's had a nice run. It's had a recent pullback. You can see that spike up there on the chart. And I think this pullback is a nice consolidation. We've been buying it in here, and I think the next move is higher.
Okay, Peter, hang on. We've got to take a quick break. But when we come back, we want to talk about some real estate companies as well in Australia. I'm back with Peter Schiff of Euro Pacific Capital. We're talking about investments in Australia and in New Zealand. Now, we've been talking about basic materials, but let's talk to something else that's basic, which is real estate. And I know that there's one company there that you're very interested in, which is Investa. Tell us about Investa. It's a real estate investment trust. Is that correct?
Yeah, real estate investment trusts are probably among my clients' most, largest holdings around the world. I mean, basically, if I like an economy, if I like a country, why not buy property? I think residential real estate is pretty pricey in most parts of the world, so we've concentrated on commercial and industrial properties, office buildings, shopping centers, industrial type properties. And we get pretty good yields there. In general, we get yields of 6, 7, 8, or 9% on REITs. Now, the REITs in Australia, I mean, one of the reasons that I like Australia, again, is for the natural resource and commodities, but you don't need to own a natural resource company to benefit from a booming economy that's based on resources. So if you own property, obviously you're going to have upward pressure on rents, and that's what you want.
And one of them is Investor.
Sure.
Really is the biggest, isn't it?
Sure, and look at the chart of Investor. You can see the upward movement in the price. And that, remember, this chart is in Australian dollars. So if this chart were...
So every time this goes up, you have to multiply it almost by how much the Australian dollar goes up versus the U.S. dollar.
Right. So if these prices were in American dollars, the chart would have a much steeper ascent to it. And I think you can look at the chart right here. It looks to me like it's consolidating, getting ready to break out yet again to move to new highs. And
now, do you ever worry that the Australian market is a little bit overheated? I mean, they've high debt levels at Investa. There have been some issues with one of their investments, Clarendon. They had to do some write-offs of some contract housing. Don't you worry a little bit that it could get overheated? I mean, everyone has been talking about real estate in Australia for a while.
Yeah, there's always these risks in these stocks. I mean, yet a lot of the real estate trusts that I own continue to make new highs, not only in Australia, also in New Zealand and Europe. I've got real REITs that we own in Europe that have doubled in a short period of time. I don't know when it's going to stop. I think that there is a demand for real assets. There's a lot of inflation in the world, not only in the United States. It's being created all around the world. And people understand this, and they want to own real things. They want to own stuff. They want to own buildings, and they don't want to clip coupons. They want to earn rents.
What would give you pause for something like Investa? Is there a point at which you would look at it and you would say the run-up has been too dramatic, it's been too fast?
Sure.
I'm going to sit this one out.
I suppose if the chart kind of went straight up and the yields no longer made sense.
We're talking about 6.5% right now for the yield on Investa.
Yeah, I mean, if the yields got to the point where they were ridiculously low, 2 or 3%. Or something, and I said, look, that doesn't make any sense to own them. We might as well sell the stocks and redeploy them. But at my company, I try to sell stocks as infrequently as possible. We have a lot of capital gains for clients, and there's really no reason to realize those gains and pay taxes because then you don't have as much money to redeploy. And it's hard to replace the yields. But I still think commercial real estate is a good bargain.
Okay, now this is real estate in Australia. What about real estate in New Zealand? What about the Kiwi Property Trust?
In fact, Kiwi Income Property just spiked up. I'm even getting a little bit nervous there. If you put up a chart on Kiwi Income Property, which is our single largest holding at Euro Pacific Capital. Up
20% this year, 6% yield.
Well, look at that spike here. The New Zealand government just made some changes to tax laws.
About capping the tax rate for
now, unfortunately, that doesn't benefit most of my clients because they don't live in New Zealand, but it has caused the price to rise. And so I'm looking at it, maybe we might move a little bit of money out of it, but I'm not sure. I mean, look at that chart. It's very powerful. And I still really like having money in New Zealand, and we have such enormous capital gains in this stock for people that, sometimes it's difficult to sell.
Okay, now from real estate, let's just talk a little bit about restaurants because people have to eat as well. And there's one restaurant stock that you're interested in, and this, I think it got out of the Pizza Hut business in Australia, and it's really concentrating on New Zealand, Restaurant Brands.
Restaurant Brands, that's been a stock that's gone in and out of favor in New Zealand for the years that I've owned it. I always buy the stock when it goes down, and it's had a big drop.
Certainly has. I mean, it certainly has gone down. It's down about 12.5% this year.
Right, in New Zealand terms. In American terms, it's probably about a push, but it pays a pretty good dividend. But recently they had to cut the dividend because of some losses that they suffered from some Pizza Huts that they bought in Australia. It was a very bad move. I wish they hadn't done it as a shareholder. They destroyed some value, but they've sold those restaurants. And I think within the next year or so, they're going to be able to increase their dividend substantially. And right now the stock is out of favor. Nobody likes the management. I think that's a great time to buy an income-producing asset when it is out of favor. You get a better price on it. You can see the stock looks like it maybe bottomed here recently. That spike up was on the news that they did find a way out of these Australian restaurants, but they have the exclusive franchise in New Zealand for Pizza Hut, Kentucky Fried Chicken.
I'm sorry,
and
you're going to have to come back and tell us about Australia and New Zealand. We've run out of time with you. Thanks for joining us, Peter Schiff of Euro Pacific Capital. We'll be right back.